What if I told you that the richest traders in the world started with absolutely nothing? Not small account, nothing. I mean zero, paper, fake money. And that's exactly why they won. Welcome to Trading Psychology Stick, the place where amateurs unlearn hype and rebuild themselves into traders who last. This isn't another trading tutorial. This is a psychological bootcamp disguised as a YouTube video. Because the truth is, most people don't fail because of bad strategies. They fail because they never trained their brain. So if you're brand new, perfect. Because starting from zero means you have no bad habits to unlearn. You're an empty glass, ready to be filled. And today, we're going to fill it with process, precision, and pain-proof mindset. Quick disclaimer before we go deeper. This video is not financial advice. This is education for people who are tired of gambling and want to train like professionals. Trading carries risk, but so does staying where you are. If you commit to the full journey in this video, you'll walk away with something no course can sell you. A brain that thinks like the top 1%, even if your account still says dollars. Now let's start from where every legend began. Nothing but obsession, paper, and process. Chapter 1. The $0 start. Every guru screams, you need $25,000 to day trade. They're lying. Here's proof. The empty account advantage. When you have nothing to lose, you have everything to learn. An empty glass can be filled with pure water. A full glass can only overflow. Picture this. Paul Tudor Jones, 28 years old, just fired from his job, sitting in a rented apartment. No Bloomberg terminal, no smartphone, no capital. Just a notebook and an obsession. Every single day, he'd run to the public library, copy stock prices from yesterday's newspaper, draw charts by hand, calculate moving averages with a pencil. Paper trading in the most literal sense. But here's what most people miss about paper trading. It's not just clicking buttons with fake money. That's a video game. Real paper trading is a business simulation. Before every single trade, you must write down 3 things. First, your thesis. I am buying here because X, Y, and Z. Second, your invalidation. If price breaks below this level, my thesis is wrong. Third, your target. My profit target is here based on this structural reason. At the end of each day, you don't review your fake P&L. You review your decisions. Did you follow your own rules? That's the only metric that matters. For 3 years, he traded fake money, tested every idea, lost imaginary millions, learned real lessons. Then, when he finally had $30,000 to trade, he was ready. The result? His fund gained 62% during Black Monday 1987. While Wall Street burned, he printed money. Why? Because money doesn't create good traders. Process creates good traders. And that process? It's free. Paper trading isn't pretending. It's your dojo, where samurai train before holding real swords. But here's the untold story about Paul Tudor Jones that changes everything. After his Black Monday triumph, reporters asked him, "What's your secret?" His answer? "I failed on paper 10,000 times before I succeeded once with real money." Think about that. 10,000 failures. Each one documented, each one analyzed, each one teaching him what not to do. He had a failure journal, 3 columns. What I thought would happen. What actually happened. What I learned. By the time he put real money at risk, he'd already made every possible mistake. For free. The average trader loses $30,000 learning the markets. Jones lost $0. Who's smarter? Chris Camillo started paper trading in college. 0 capital. 3 years later, he turned 20K into 2 million. Not because he was lucky, because he was prepared. How many times have you said, "If only I had capital"? What if from today, you stopped waiting for perfect conditions? What if you started with exactly what you have? Nothing but hunger. Your future self is watching you right now. What will you show them? But here's the dark truth about paper trading that nobody tells you. It doesn't prepare you for the emotional pain of a real loss. You know the money isn't real, and that's okay. Because the goal of paper trading is not to learn how to feel. The goal is to build a process so robust, so mechanical, so ingrained in your muscle memory, that when the emotional storm of real trading hits, your process becomes the lifeboat that you cling to. Paper trading builds your technique. Real trading tests your soul. Start with technique. Here's your paper trading drill for the next 30 days. Week 1, trade only one pattern. Document everything. Week 2, add position sizing rules. Never break them. Week 3, add time restrictions. Trade only 2 hours daily. Week 4, review all trades. Find your recurring mistakes. After 30 days, you'll have 100 plus trades documented. That's your foundation. That's your edge. Most people want to run before they can walk. Be different. Master walking. Chapter 2. The Casino Revelation. Trading isn't gambling. If you understand this one mathematical fact, that casinos pray you never learn. The house edge flip. Casinos win with a 51% edge. Traders win with the same edge. But there's a catch. Let me tell you about Edward Thorpe, MIT professor, 1962. He walked into Vegas casinos with a notebook full of equations. Security watched him like a hawk. Pit bosses sweated. Because Thorpe had done the impossible. He'd mathematically proven how to beat blackjack. His edge, 51%. Casinos panicked, changed rules. Banned him from every establishment in Nevada. So Thorpe laughed and took his formulas to Wall Street. Same math, same 51% edge, different game. The result? His hedge fund never had a losing year, not once in 20 years. But here's the part of Thorpe's story they don't tell you in the movies. Before he ever placed a real bet, Thorpe played 100,000 hands in his mind. He'd deal cards to himself in his office, track every outcome, calculate probabilities. He discovered something profound. The edge only works if you survive long enough for probability to play out. One bad bet with too much capital, dead. Even with an edge, his rule, never bet more than 2% of capital, even with 51% edge, even when he knew he'd win. Why? Because knowing and proving are different things. Probability needs time. Time needs survival. Survival needs small bets. Here's what casinos understand that most traders don't. You don't need to win every hand. You need to win $110 when you're right and lose $100 when you're wrong. Do that 1,000 times, you're rich. It's not magic, it's math. The casino doesn't cry when someone wins a hand. They know the edge plays out over time. But you panic after one loss. Here's the math that made Thorpe billions. Kelly criterion, bet size equals edge divided by odds. If you have 10% edge with even odds, bet 10% of capital. If you have 5% edge with even odds, bet 5% of capital. If you have 0% edge, bet nothing. Most traders bet 50% with no edge. Then wonder why they're broke. Think about your last losing trade. Did you feel that stomach punch? That urge to win it back? That's not trading. That's gambling. What if you saw losses like a casino does? Just operating expenses? Cost of doing business? What if you became the house? But here's the hidden truth about the casino model. Casinos have one advantage you don't. They can ban winners. You're competing against other traders who also know the edge. It's not casino versus gamblers. It's shark versus shark. The real edge isn't mathematical. It's psychological. It's doing what the math says when every fiber of your being screams otherwise. Can you place the 500th trade with the same discipline as the first? That's the real question. But to become the house, first you need to understand your biggest enemy. And it's not the market. Chapter 3. Your brain is the enemy. Your brain is 150,000 years old. The market is 400 years old. Guess which one is winning? The Savannah paradox. Your brain thinks every red candle is a lion attacking. 150,000 years ago. Serengeti Plains. Your ancestor hears rustling in the grass. Fight or flight. Adrenaline floods. Heart hits 180 BPM. Pupils dilate. Muscles tense. Wrong equals death. Right equals survival. Fast forward, 2025, 9:31 a.m., you, staring at your screen, red candle appears. Exact same biological response. Your brain screams, danger, run. You panic sell. The bottom. Price bounces. You punch your keyboard. Here's the thing. It's not your fault. It's evolution's. But here's the neuroscience they don't teach you. Your amygdala, the fear center, processes information 12 milliseconds faster than your prefrontal cortex, the rational center. You literally feel before you think. In the savannah, this saved your life. In the market, it destroys your account. The solution isn't to fight your biology. It's to hack it. Mark Douglas spent 20 years studying trader psychology. His discovery? Great traders don't conquer emotions. They rewire biological responses. Red candle isn't a lion, it's a data point. Stop loss isn't failure, it's insurance. Losing trade isn't death, it's tuition. Navy SEALs use box breathing to override their amygdala in combat. Traders can too. Inhale 4 seconds, hold 7 seconds. Exhale 8 seconds. Do this before every trade. Your reptilian brain calms. Your prefrontal cortex takes control. But box breathing is your first aid kit. For long-term rewiring, you need to create a trading persona. Give your ideal trading self a name. The executor, the sniper, the process machine. Before a trading session, you perform a small ritual. Put on a specific hat, listen to a specific song, and you become that persona. The executor doesn't feel FOMO. He doesn't revenge trade. He just follows the rules. This psychological separation between you and the trader is the secret weapon of the pros. It creates a buffer against your 150,000-year-old brain. Here's a 7-day brain rewiring challenge. Day 1 to 2, the observer phase. Sit with charts for 30 minutes. Do not trade. Just observe your thoughts. Write down every urge. Wanted to buy here because you're mapping your impulse patterns. Day 3 to 4, the narrator phase. Watch price action and narrate like a sports commentator. Price approaching resistance, buyers showing exhaustion, sellers entering. You're building objective observation skills. Day 5 to 6, the robot phase. Paper trade with one rule. No trade without 60 seconds of box breathing first. Feel the difference between impulse and decision. Day 7, the integration. Review all your notes. You'll see your patterns, your triggers, your weaknesses. Congratulations. You just completed Trader Psychology 101. Most people pay $5,000 for this in a seminar. You just got it free. Because knowing isn't the problem. Doing is. Remember your last FOMO buy at the top or panic sell at the bottom. That wasn't weakness. That was your brain doing exactly what 150,000 years of evolution programmed it to do. Question is, will you stay a slave to ancient wiring, or will you evolve? But evolution requires awareness of the predators. Speaking of which, let's talk about the ones hunting you in these markets. Chapter 4. Spot the inside men. In 2020, the FTC exposed traders making millions, who had never placed a real trade. Here's how the scam works. The signal seller paradox. If someone could print money trading, why would they need your 97s? Meet Trader Bro Fiore69. Real name, Kyle, from Ohio. Every morning, he posts Lamborghini pics. Made $50K before breakfast, Dubai penthouse views, private jet selfies. His course, only $9.97. Learn my secret strategy. One problem, Kyle's never traded, ever. That Lambo, rented for $500, penthouse, Airbnb, trading screenshots, Photoshop, his actual income, your course payments. But here's the deeper psychology of why you fall for it. Your brain is wired for social proof. When you see lifestyle images, your mirror neurons fire. You literally feel yourself in that Lamborghini. Scammers know this. They're not selling trading education. They're selling dreams. The formula is predictable. Display wealth, usually rented. Show proof, always edited. Create urgency, only 10 spots left. Price anchor, usually $5,000. Today only 997s. Risk reversal, 30-day guarantee. Your emotional brain is screaming, what if this is real? What if I miss out? Your logical brain is drowned out. In 2020, the FTC shut down 17 similar operations. Combined victim losses, $231 million. But here's the deeper scam. Even legitimate signal services are selling you garbage. Why? Because edges expire. If 10,000 people trade the same signal, the edge vanishes. It's like giving everyone the same treasure map. First person gets gold. Everyone else gets dirt. Real traders guard their edge like nuclear codes. They don't sell it for 97. Here's a secret from a hedge fund trader. We spend millions developing strategies. If one leaks, we burn it immediately. A public edge is a dead edge. Think about it. Renaissance Technologies, the most successful fund ever, makes employees sign lifetime NDAs. One strategy leak, suit into oblivion. But Trader Bro 469 will teach you his secret strategy for 3 easy payments. Right. How many courses have you bought? How many signals have you followed? How many made you rich? What if the real secret is there is no secret? What if success is just math, discipline, and time? What if everything you need is free, and everyone selling you secrets is the real enemy? Here's how to spot the fake gurus instantly. 1. They talk more about lifestyle than process. 2. They show profit screenshots but never losses. 3. They have limited time offers every week. 4. They promise specific returns, make $5K per week. 5. They never show multi-year audited results. Real traders, they're boring. They talk about risk management, not Lamborghinis. Now, let's talk about the only edge that actually matters, and it's been hiding in plain sight for 60 years. Chapter 5. The Mathematical Edge. This math formula made a professor persona non grata in every casino. Then he used it to get rich on Wall Street. The 51% revolution. You don't need to be right often. You need to be right profitably. Edward Thorpe, MIT, teaching probability to bored students. Imagine, he said, you could flip a coin where heads pays $3 and tails costs you $1. Students perked up. Would you play? Obviously. Congratulations. You just understood how every casino on Earth makes money. But Thorpe went further. He proved you could reverse engineer the edge. Turn yourself into the casino. Blackjack, card counting, 51% edge. When Vegas banned him, he thought, where else do probabilities rule? The stock market. His Princeton Newport Partners Fund used the same principle. Small edge, many trades, let math work. Result, 227 months of trading, 226 profitable. The one loss, 0.5%. Average annual return, 19.1% for 20 years straight. Here's your $1 million math lesson. Win, rate times, average. Win minus loss. Rate times average loss equals edge. Example, win 45% of trades at 3-to-1 reward. Lose 55% of trades at 1x risk. Edge equals 0.45 times 3 minus 0.55 times 1 equals 0.8. You're losing more than winning, still profitable. But here's what they don't teach in probability class. The edge isn't just mathematical, it's psychological. Every time you take a trade with positive expectancy, you're doing something 99% of humans can't do. You're accepting a probable loss for a possible gain. Think about that. Your brain screams, "This might lose," and you reply, "I know, that's part of the plan." This is why lottery tickets sell billions despite negative expectancy. People prefer improbable wins over probable losses. You're training yourself to think opposite to human nature, to embrace probable losses as the cost of inevitable gains. That's the real edge, not the math, the mindset that lets you execute the math. Here's Thorpe's actual trading process. Find inefficiency, the edge. Calculate optimal position. Size, Kelly criterion. Execute without emotion. Track results obsessively. Adjust or abandon based on data. No opinions, no predictions, no hope, just math. This is why amateur traders fail. They chase 90% win rates. Pros chase positive expectancy. You've been taught your whole life, more correct answers equals better grade. In trading, wrong 55% of the time can make you rich. Here's the expectancy calculation that changed my life. My system, 40% win rate, 1.3 risks at reward. Expectancy equals 0.40, x3 minus 0.60, x1 equals 0.60. Every trade has positive expectancy of 0.60 R. Take 100 trades plus 60 R expected. Lose 60 times, win 40 times. Still profitable. Can your ego handle being wrong more than right? If not, you'll join the 95% who fail. What matters more to you, being right or being rich? But knowing the math is useless if you can't read the language of the market. Let me decode it for you. Chapter 6, The Chart Whisperer. After staring at charts for 50,000 hours, you start seeing things others can't, like this. The river map method. Charts aren't random, they're conversations between titans. Peter Brandt, trading since 1975. No indicators, no algorithms, just price. I asked him once, how do you see what others miss? He pulled up a chart, drew 3 lines. See this? Line 1, that's the river, where price wants to go. Line 2, that's the boat, where we can jump on. Line 3, that's the anchor, where we admit we're wrong. Everything else is noise. So, what are these 3 lines? Think of it this way. Line 1, the current. This is the dominant trend on a higher time frame, like the daily chart. Is the river flowing up or down? Line 2, the raft. This is your entry point on your execution time frame, like the 4-hour chart. It could be a clear support level, a breakout from a consolidation pattern. It's where you can safely get on the current. Line 3, the anchor. This is your stop loss, placed at a point where the entire structure of the trade breaks. If the anchor is hit, the raft is sunk, and you get out. The market is flowing, you find a raft, and you have an anchor. That's it. That's the trade. But here's what Brandt didn't tell the interviewers. Those 3 lines took him 20 years to see clearly. First 5 years, he saw 50 lines, all important, all confusing. Next 5 years, he saw 20 lines, getting clearer. Next 5 years, he saw 10 lines, almost there. Final 5 years, he saw 3 lines. Mastery. Leonardo da Vinci said, "Simplicity is the ultimate sophistication. In trading, simplicity isn't where you start, it's where you arrive." In 2020, he called Bitcoin's move from 10K to 60K. 3 lines, that's it. 600% gain, 3 lines. While others drew 47 indicators, Brandt drew 3 lines and went to play golf. Markets speak a simple language. Big green candles equal institutions buying. Round numbers equal algorithm targets. Gaps in price equal unfilled orders. Repeated tests equal building pressure. But here's the advanced chart reading nobody teaches. Volume tells you who is trading. Price tells you what they're doing. Time tells you how confident they are. High volume, small price move, accumulation or distribution. Low volume, big price move, weak hands folding. Sideways price, declining volume, coiling spring. The chart isn't just showing price, it's showing psychology, fear, greed, capitulation, euphoria. Learn to read the emotions, not just the candles. You don't need to predict, you need to listen. The chart is telling you banks are buying here, sellers are trapped there, pressure is building. All you do is position yourself before the dam breaks. How many indicators are on your chart right now? 5, 10, 20? What if each indicator is just noise drowning out the market's actual voice? What if simplicity isn't just better? What if it's the only thing that works? Could you delete everything and trade with just 3 lines? But even perfect analysis is worthless without the element most traders discover too late. Chapter 7. The Time Arbitrage Secret. I'm about to show you why day traders drive Toyotas while swing traders drive Teslas. The time frame tax. The lower you go, the more you pay. In stress, mistakes, and losses. Meet Jake, day trader, 15 monitors, IV drip of Red Bull, wakes at 4 a.m., trades every tick, 50 trades a day, burnt out by noon, annual return down 12%. Meet Sarah, swing trader, 1 laptop, coffee at 9 a.m., checks charts for 20 minutes, places 1 trade, goes to yoga, annual return up 47%. The difference? Jake fights in a knife fight, the 1-minute chart. Every algorithm, every bot, every HFT firm is his enemy. Sarah plays chess, the 4-hour chart. She waits for the obvious moves, the ones institutions telegraph days in advance. But here's the mathematics of why lower time frames destroy accounts. The spread tax. On a 1-minute chart, spread eats 50% of your average move. The noise ratio. 90% of 1-minute moves are meaningless noise. The decision fatigue, 50 decisions daily versus 2 decisions weekly. The stress compound. Cortisol levels spike every losing tick. It's not that you can't make money day trading, it's that the cost is exponentially higher. Like mining gold with tweezers instead of an excavator. Possible? Yes. Smart? No. Nikola Darvas made millions trading while touring the world as a dancer. His secret? He only looked at daily charts, sent telegram orders to his broker, checked positions once a week. The money is made in waiting, not trading. Higher time frames equal clearer signals, less noise, fewer mistakes, better sleep. Your edge isn't speed, it's patience. Here's the time frame profit matrix I discovered. 1-minute chart, 95% lose money. 5-minute chart, 90% lose money, 1-hour chart, 70% lose money, 4-hour chart, 60% lose money, daily chart, 40% lose money, weekly chart, 20% lose money. Notice the pattern: higher time frame, higher success rate. Why? Because institutions can't hide their footprints on higher time frames. A manipulation on 1 minute is invisible on daily, but accumulation over weeks, crystal clear. Be honest, are you addicted to the action, the adrenaline of quick trades? That's not trading. That's gambling with extra steps. What if the path to wealth is more boring than you imagined? What if boring is exactly what makes you rich? Can you handle getting rich slowly? Here's your time frame transition plan. Week 1 to 2, your current time frame. Week 3 into 4, 1 time frame higher. Week 5 into 6, 1 more time frame higher. Week 7 under 8, compare results. I guarantee higher time frames equals higher profits. The only question is whether your ego can handle less action. Once you've got the right time frame, you need to know where the big money hides. And I'm about to expose their favorite hiding spots. Chapter 8. The Supply and Demand Masterclass. Goldman Sachs can't buy 10 million shares without you noticing, if you know where to look. The warehouse theory. Big money doesn't chase price. They build positions in zones. Paul Tudor Jones, billionaire trader, once said something that changed my life. I don't trade markets. I trade market participants. What did he mean? Watch, right here. Price goes sideways for 3 days. Boring, right? Wrong. That's Goldman Sachs accumulating, slowly, quietly, building their warehouse. Then, boom, price explodes up 15%. Retail traders. Where did that come from? Tudor Jones. Exactly where I expected. Here's a secret from a former Goldman trader. We had a saying, build in the shadows, reveal in the light. They accumulate when nobody's watching, pre-market, after hours, during lunch, when retail is distracted by other shiny objects. The accumulation phase has 3 stages. Stage 1, the shakeout. They push price slightly below support, trigger stop losses, create fear. Stage 2, the absorption. They buy everything. Every sell order gets absorbed. Price goes nowhere. Volume surges. Stage 3, the spring. A final push down, the ultimate bear trap, then explosion. If you see all 3 stages, the move is coming. It's not prediction, it's pattern recognition of institutional behavior. Watch any major breakout. You'll see this pattern every single time. Every major move starts the same way. Accumulation, markup, distribution, markdown, find the warehouses, front-run the institutions. Institutions can't hide. They're too big, like whales in a swimming pool. Look for high volume plus flat price equals accumulation. Break of structure equals direction confirmed. Retest of zone equals your entry. Stop outside, zone equals protection. But here's the advanced supply and demand nobody teaches. Not all zones are equal. Quality matters. Fresh zones, untested, maximum power. Tested zones, weakened. Approach with caution. Multiple test zones, dead. Avoid completely. The best zones have 3 characteristics. 1. Strong move away, explosive, not gradual. 2. Clear consolidation before the move. 3. Untested, fresh ammunition. Find zones with all 3. That's where institutions have unfinished business. You're not predicting, you're following footprints. Giant billion-dollar footprints. You've been trying to outsmart the market, but what if you just need to follow the smart money? They leave clues everywhere. Are you paying attention? Or are you too busy drawing trend lines on noise? Now here's where it gets interesting. You don't need $1 million to trade like you have $1 million. Chapter 9. The Leverage Multiplier. Banks use 30-to-1 leverage and get bailed out. You can use 10-to-1 leverage and get rich, if you're not an idiot. The Dynamite Principle. Leverage isn't dangerous. Stupidity with leverage is dangerous. Long-term capital management. Dream Team. 2 Nobel Prize winners, 16 PhDs. Combined IQ, unmeasurable. Position size, 25% per trade. Leverage, 100-to-1. We've solved the market, they said. Our models can't fail. August 17th, 1998. Russia defaults. In their models, impossible event. In reality, happening right now. Imagine the silence in that room full of PhDs. Their beautiful Nobel Prize-winning models on the screen were screaming, "This event has a 0 probability of happening," while their P&L statement was bleeding billions by the hour. In that moment, they learned the market doesn't care about your IQ. It doesn't care about your credentials. It is a force of nature, and it will humble anyone who believes they have solved it. 4 weeks later, $4.6 billion becomes $0. But here's what the documentaries don't tell you about LTCM's collapse. John Meriwether, the founder, didn't disappear. He started a new fund, same strategies, lower leverage, the result, profitable for 10 years straight. The strategies weren't wrong. The leverage was. It's like driving. A Ferrari isn't dangerous. A Ferrari at 200 mph in a school zone is dangerous. LTCM drove their Ferrari at 200 mph. Meriwether learned to cruise at 100 mph. Same car, different outcome. This is the leverage paradox. The same tool that destroys amateurs creates wealth for professionals. The difference isn't the tool, it's the temperance. Warren Buffett uses leverage. Ray Dalio uses leverage. Every hedge fund uses leverage. They just don't use stupid leverage. Meanwhile, a trader named Tom Basso uses 10-to-1 leverage, 1% risk per trade, 30 years, never blown an account, quietly compound millions. Who's smarter? Leverage is a tool, like a chainsaw. Used right, build a house. Used wrong, lose a hand. Rules for survival: never exceed 10-to-1. Always calculate position size first. Stop loss is non-negotiable. Treat leverage capital like it's your kidney. Here's the position sizing formula that saved my account. Position size equals account risk x account balance. Stop distance x leverage. Example, $10,000 account 1% risk equals 100. 20 pip. Stop 10.1 leverage position size equals 100, or 20 pips x 10 equals 0.5 lots. Simple math. Saves lives. One mistake with 100-to-1 leverage equals game over. 1,000 wins with 10-to-1 leverage equals generational wealth. That voice saying, but 10-to-1 isn't enough. I need 50-to-1 to get rich fast. That's not ambition talking. That's greed. And greed with leverage equals bankruptcy. Can you build wealth at boring speeds? Or will you blow up chasing thrills? Leverage gives you firepower. But without the right daily routine, you're shooting blind. Chapter 10. The Morning Ritual Blueprint. What Ray Dalio does before 6 a.m. made him $20 billion. Want to know his morning secret? The pre-battle protocol. Wars are won before breakfast. Ray Dalio, founder of the world's largest hedge fund. Every morning, same routine. 40 years. 5 a.m., wake, no snooze, ever. 5:15 a.m., meditation. 20 minutes, non-negotiable. Meditation is the single most important thing I do, he says. 5:35 a.m., journal, 3 pages, stream of consciousness. 6 a.m., market prep, economic calendars, key levels, no opinions, just data. 6:30 a.m., exercise. If you can't manage your body, you can't manage money. 8 a.m., first trade consideration, clear mind, zero emotion. By the time markets open, Dalio has already won. But here's what Dalio doesn't publicize. His journal isn't random thoughts. It's structured. Page 1, gratitude, 3 things. Prime's abundance mindset. Page 2, visualization. Perfect trades executed flawlessly. Page 3, concerns. Write them down, then let them go. This isn't woo-woo, it's neuroscience. Gratitude activates the prefrontal cortex. Visualization creates neural pathways. Writing concerns externalizes anxiety. He's literally rewiring his brain before touching a single trade. Your morning routine is your edge. While others wake up and immediately check losses, you're preparing like a professional athlete. Trading isn't about the 30 minutes you spend executing. It's about the 3 hours of preparation that make those 30 minutes profitable. My non-negotiables: cold shower for alertness, no phone for first hour for focus. Write 3 trade ideas for clarity. Visualize perfect execution for confidence. But here's the advanced morning routine nobody talks about. The market pregame checklist. 1. Check economic calendar, what bombs could drop. 2. Note key levels on your instruments. 3. Read zero news, opinions cloud judgment. 4. Review yesterday's trades, what worked, didn't. 5. Set daily loss limit, your kill switch. 6. Write your if-then scenarios. Example, if EUR/USD breaks 1.1050, then I enter long with stop at 1.1030, pre-decided, emotionless, robotic. What's your morning? Snooze until 8:58, coffee, then panic trade at 9:30? That's not trading, that's reacting. What if you gave yourself the gift of preparation? What if you showed up like a pro instead of an amateur? Tomorrow morning, you choose. But even the perfect morning routine won't save you from the graveyard of failed strategies. Chapter 11. The Strategy Graveyard. I spent $47,000 on trading strategies. Want to know which one actually worked? The strategy hopping disease. The problem isn't your strategy, it's your impatience. My trading journey. Year 1, moving average crossovers. This is it. Lost 10K. Year 2, Fibonacci retracements. Now this is it. Lost 15K. Year 3, Elliott wave. Complex must be better. Lost my sanity. Year 4, harmonic patterns. The geometry of markets. Lost 20K. Year 5, supply and demand. Simple. Wait, this works? 47,000 in education. The lesson? Every strategy works. For someone, somewhere, sometimes. But here's the controversial truth nobody admits. Your failed strategies weren't failures. They were education. Moving averages taught you trend dynamics. Fibonacci taught you market structure. Elliott wave taught you market psychology. Harmonics taught you pattern recognition. You paid $47,000 for a trading university education. Each strategy was a different course. Now you trade supply and demand. But you see it differently than someone who started there. You see the moving average dynamic within the zone. You notice the Fibonacci relationships. You feel the Elliott wave psychology. You recognize the harmonic structures. Your simple strategy isn't simple. It's sophisticated simplicity, the kind that only comes from complexity distilled. Steve Jobs said, simple can be harder than complex. You have to work hard to get your thinking clean to make it simple. Your journey through complexity wasn't wasted. It was necessary. To achieve mastery, you first had to explore everything. Now you trade one setup, but you trade it with the wisdom of someone who's seen it all. The question isn't, what's the best strategy? The question is, what strategy can I execute for 10,000 hours without going insane? Bruce Lee said, I fear not the man who practiced 10,000 kicks once, but the man who practiced one kick 10,000 times. Trading translation, master one setup. My bread and butter, fair value gap entry. Previous high-low target. Structure low stop. 1 to 3 minimum reward. 10,000 repetitions later, I see this setup in my sleep, and it prints money. But here's the strategy secret that will save you $47,000. Every profitable strategy has 5 components. 1. Entry trigger, clear and objective. 2. Stop loss, predetermined. 3. Target, logical. 4. Position size, mathematical. 5. Management, rules-based. Missing any component, the strategy fails. Not because it's wrong, because it's incomplete. How many strategies have you tried? How many YouTube videos searching for the Holy Grail? What if the Holy Grail is just doing one simple thing over and over until it's automatic? Can your ego handle that simplicity? Or do you need complexity to feel smart? One setup, one edge, executed perfectly. But perfect execution is impossible without managing this. Chapter 12. The Emotional Bankroll. I track my emotional state like a trader tracks P&L. Green days, yellow days, red days. Red days, I don't trade. Period. The tilt tracker. Your emotions have a bankroll too. Blow it and money follows. Ever heard of Stu Ungar? Greatest poker player ever. Won millions. Died broke in a cheap motel. Why? Tilt. When he lost, he'd double down, triple down, mortgage the house down. His skill was legendary. His emotional control was 0. Sound familiar? Loss, Monday. I'll make it back Tuesday. Bigger loss. Tuesday, Wednesday's my day. Disaster. Wednesday, time for revenge. Account blown Thursday. I've been there. We all have. Until I started tracking emotions like positions. My emotional trading journal, green, calm, patient, following rules. Yellow, anxious, rushing, bent rules. Red, angry, desperate, breaking rules. Rule: no red day trading. Ever. Zero exceptions. Result: haven't blown an account in 5 years. This tilt tracker isn't just about feelings. It's about your nervous system. A green day means you're in a parasympathetic state. Rest and digest. You're calm, rational, creative. A red day means your sympathetic nervous system has taken over. Fight or flight. Your blood flows from your prefrontal cortex, rational thought, to your limbs. You are physiologically incapable of making good financial decisions in this state. The market doesn't know you're angry, but your body does. Not trading on a red day isn't weakness. It's respecting your own biology. Here's the advanced emotional management system. The HALT check. Never trade when you're hungry. Low blood sugar equals poor decisions. Angry, emotional hijacking. Lonely, seeking validation through wins. Tired, impaired judgment. Before every session, rate yourself 1 to 10 on each. Below 7 on any, no trading. But here's what changed everything for me. The 24-hour rule. After any losing day, mandatory 24-hour break. Not because you can't win tomorrow, because you need perspective. Every blown account starts with, I'll just take one more trade to get back to break even. That one more trade is Russian roulette. But I'm leaving money on the table. No, you're leaving Dynamite unexploded. After your last big loss, what did you do? Be honest, did you immediately try to win it back? Did you increase position size? Break your rules? That's not trading, that's self-destruction with extra steps. What if you had a kill switch? What if red days meant stepping away, not stepping up? Managing emotions is defense. Now let's talk offense. How to spot the setups that actually pay. Chapter 13, The Market Maker's Playbook. Market makers aren't your friend, they're hunting your stops. Here's how to avoid becoming prey. The stop hunt safari. They know where you put stops, so put them where they don't expect. Watch this. Every single time. Support at $100. Where does everyone put their stop? $99. The market drops to $98.97, triggers all stops, then immediately reverses to $105. Manipulation, traders scream. No. Business. Market makers need liquidity. Your stops are liquidity. They're not evil, they're efficient. Fun fact, there's a former market maker on Reddit who revealed their playbook. His confession. We had heat maps showing exactly where retail stops clustered. It looked like a Christmas tree, bright red zones at obvious levels. Our job was simple: push price to the red zones, collect liquidity, let price return to value. The most profitable zones, round numbers -1 cent, previous day low -1 cent, 50% retracements exactly. We called it stop hunting season, not because we were evil, because it was predictable, like fishing where the fish always gather. His advice: place stops where it hurts. If it feels comfortable, you're in the cluster. If it feels too far, you're probably safe. The market maker's edge isn't sophistication. It's exploiting human predictability. Be unpredictable. The pattern never changes. The victims never learn. Stop loss. Invisibility cloak. Don't place at recent low -0.1. Do place at market structure break. Don't use round numbers like 99s. Do use ugly numbers like 9873. Don't follow the herd. Do follow the logic. But here's the advanced stop placement strategy. The ATR method. 1. Calculate average true range, ATR. 2. Multiply by 1.5. 3. Place stop that distance from entry. 4. Never at obvious levels. This puts your stop beyond normal volatility, but inside your risk tolerance. Market makers hunt obvious stops. Be non-obvious. Where's your stop loss right now? Let me guess. Right below support? Congratulations, you're on the menu. What if you started thinking like the hunter, not the hunted? What if you put stops where logic dictates, not where everyone else does? Avoiding the hunters is step 1. Step 2 is understanding the magical math of compound growth. Chapter 14. The Compound Effect. Einstein called compound interest the 8th wonder of the world. Watch what happens when you apply it to trading. The snowball system. Small gains, massive dreams. Let me blow your mind with basic math. Start, $1,000. Daily goal, 1%. Trading days, $220 per year. End of year 1, $9,000. End of years 2, $81,000. End of year 3, $729,000. Impossible, you say. You're right. So let's get real. Let's be brutally honest about that 0.5% daily average. That is not a smooth lineup. In reality, it looks like this: plus 2%, minus 1.5%, plus 0.5%, minus 1%, minus 1.2%, plus 3%. It's a violent, jagged journey upward. The number is an average over hundreds of trades. The real magic isn't in the compounding itself. It's in having the risk management and emotional fortitude to survive the vicious drawdowns that are a guaranteed part of the journey. Most people quit during the first drawdown. The 1% survive it. Here's what a real equity curve looks like. Month 1, up 5%. Month 2, down 3%. Month 3, up 8%. Month 4, down 6%. Month 5, up 12%. Month 6, down 2%. 6 months, up 14%. Not smooth, not easy, but profitable. That's reality. Accept it or quit now. 0.5% daily average accounting for losses. Year 1, $3,000. Year 2, $9,000. Year 3, $27,000. Still triple your money annually, still life-changing. Warren Buffett averaged 20% per year and became the richest investor alive. You can average 100% per year as a skilled trader. The difference? Time in the game. The compound mindset shift. Stop thinking, I need to make 10K this month. Start thinking, I need to survive and compound for 10 years. My actual progression. Year 1, 1K becomes 3K. Learning, surviving. Year 2, 3K becomes 15K. Finding edge. Year 3, 15K becomes 60K. Consistency. Year 4, 60K becomes 250K. Scaling. Year 5, 250K becomes $1 plus. Mastery. Slow? Yes. Millionaire? Also yes. But here's the compound secret nobody tells you. The biggest threat to compounding isn't losses, it's withdrawals. Every time you withdraw for bills, toys, or flexing, you reset the compound clock. 10K growing at 100% yearly. Year 5, 320K. 10K growing at 100% yearly, with 5Ks withdrawn annually. Year 5, 85K. Same returns. 1/4 the result. The compound equation has 3 variables. 1, principal, starting amount. 2, rate, your edge. 3, you control all 3. But time is the most powerful. You want the year 5 results with year 1 experience. Life doesn't work that way. Markets definitely don't. Can you embrace the journey? Can you fall in love with the process, not just the profits? If not, you'll quit in year 2, like 95% do. Compound growth is powerful, but first, you need to find trades. Let me show you exactly how. Chapter 15. The Scanner System. 40,000 tradable instruments. You need 3. Here's how to find your 3. The needle finder. More choices equal more mistakes. Less is literally more. New traders screen, 47 charts, 200 watch list items, 15 time frames. Result, analysis paralysis, missed opportunities, bad trades. My screen, 3 charts, 10 watch list items, 2 time frames. Result, clarity, precision, profits. How I filter 40,000 down to 3. Monday, scan top 20 volume movers. Tuesday, identify clean trends. Wednesday, mark key levels. Thursday, wait for setups. Friday, execute best 2 to 3. That's it. That's the whole system. The focus filter. F for flowing, trending clearly. O for obvious, levels jump out. C for clean, no choppy action. U for upcoming, approaching key levels. S for simple, grandma could trade it. Let's run a live example of the focus filter. Look at this chart of asset XYZ. F for flowing? Yes, clear uptrend on the daily. O for obvious. Yes, there's a huge obvious resistance level at $100 that's been tested 3 times. C for clean? Yes, the price action isn't a chaotic mess. It's moving with clear impulse and correction waves. U for upcoming? Yes, it's currently at $98, approaching that key level. S for simple. The thesis is dead simple. If it breaks $100 with conviction, it's likely to run hard. This asset passes the filter. All other 40,000 instruments, I don't care about them today. But here's the scanner secret that took me years to learn. The best trades aren't found, they find you. When you focus on 3 instruments for months, you develop intuition. You know their personality, their rhythm, their tendencies. EUR/USD at 1,000, you've seen this movie before. Gold at resistance, you know exactly how it behaves. S&P at all-time highs, you've traded this pattern 50 times. Expertise beats variety. Every time. Bruce Lee, I don't fear the man who practiced 10,000 kicks. I fear the man who practiced one kick 10,000 times. Trading translation. Master 3 instruments, completely rather than know 100 superficially. If it doesn't pass all 5, it's not a trade. Quality over quantity. Always. How many screens do you have open right now? How many indicators? How many watch lists? What if overwhelm is killing your profits? What if less really is more? Could you trade just 3 instruments for a month? Could you master them completely? You've got your 3, you've got your setup, but nothing prepares you for the emotional tornado of real losses. Chapter 16, The Failure Museum. I'm about to show you 150,000 worth of mistakes, for free. You're welcome. Welcome to my Museum of Failure. Admission is free. The lessons cost me everything. The tuition invoice. Every master paid it. The question is, will you learn from it? Exhibit A, the no-stop loss disaster. Date, March 2017. Loss, down $45,000. Lesson, it'll come back is not a strategy. The full story, Tesla earnings. I was sure they'd beat. Bought calls, no stop. Earnings missed, stock tanked, I held. It's oversold, it'll bounce. It didn't. Options expired worthless. 45K gone in 3 weeks. The real lesson? Being right about direction means nothing if you're wrong about timing. Exhibit B, the averaging down apocalypse. Date, June 2018. Loss, down $30,000. Lesson? Adding to losers is like drinking poison and expecting the market to die. The psychology, down 5K. Great cheaper prices, added more, down 10K. Even better value, added more, down 20K. It has to turn here, all in, down 30K. Account blown. Averaging down feels smart. It's actually doubling down on being wrong. Exhibit C, the FOMO fiasco. Date, December 2020. Loss, down $25,000. Lesson, if everyone's talking about it, you're already too late. Bitcoin at 29K, it's going to 100K, everyone said so. Twitter, YouTube, taxi drivers. Bought with size. It topped at 30K, crashed to 20K, panic sold the bottom. When your grandma asks about Bitcoin, the top is in. Exhibit D, the leverage lunacy. Date, March 2021. Loss, down $50,000. Lesson, 50-to-1 leverage is financial Russian roulette with 5 bullets. GameStop mania, this time is different. 50.1 leverage. What could go wrong? Everything. 1-2% move against me equals account gone. It moved 3%. The math was simple. My greed was simpler. Total tuition, $150,000. Value of education, priceless. Because I learned something, failures aren't failures if you learn. They're data. My failure framework. Document everything. Screenshots, emotions, thought process. Find the pattern. What repeatedly kills me. Create a rule. Never do X again. Make it automatic. Systems over discipline. Now my rules protect me from myself. 1. Stop loss on every trade. Save me 200K plus. 2. Never average down. Save me 100K plus. 3. When everyone's talking, I'm not trading. Save me 150K plus. 4. Max. 10.1 leverage saved my entire career. Each rule written in blood. Each rule worth its weight in gold. What's your most expensive mistake? Did you learn from it? Or did you just feel bad? Pain without progress is masochism. Pain with progress is education. Which are you choosing? Learning from failures is crucial. But there's one trait that separates pros from everyone else. Chapter 17. The Professional's Edge. Amateurs focus on being right. Professionals focus on being rich. Here's the difference. The pro protocol. It's not what they do, it's what they don't do. Amateur Alex trades every day, can't miss opportunities, 15 positions open, diversification, checks phone every 5 minutes, changes strategy monthly, celebrates every win on Instagram. Professional Patricia trades 3 to 4 times per week, 1 to 2 positions max, checks twice daily, same strategy for 5 years. Nobody knows she trades. End of year results. Alex, down 37% and an ulcer. Patricia, up 67% and sleeps 8 hours. The difference isn't skill, it's behavior. But here's what separates professionals at a deeper level. Professionals track different metrics. Amateurs track win rate, P&L, account balance. Professionals track R multiple, expectancy, maximum drawdown. Amateurs ask, how much did I make? Professionals ask, how well did I execute? Amateurs focus, profits. Professionals focus, process. Here's a professional's actual trading log. Trade 1, followed rules perfectly, lost 1R, grade A+. Trade 2, broke position, size rule, 1, 2R, grade F. Trade 3, perfect execution, 1, 3R, grade A+. Notice? The losing trade got an A+, the winner got an F. Process over profits, always. The professional's commandments: preserve capital over make money, process over outcomes, boring over exciting, consistency over home runs, systems over emotions. Amateurs ask, how much can I make? Pros ask, how much can I lose? Amateurs focus on entries, pros focus on exits. Amateurs want action, pros want edge. But here's the professional secret that changed my career. The 2% club, risk max 2% per trade. Take only A+ setups. Review every trade. Sounds simple? Is simple. That's why it works. Complexity is where amateurs hide their lack of discipline. Look at your last 20 trades. How many were planned? How many were impulsive? If more than 20% were impulsive, you're trading like an amateur. No judgment, just data. But data that could save your account. Are you ready to be boring and rich, or exciting and broke? Acting like a pro requires the right tools. Here's exactly what you need, and it's less than you think. Chapter 18. The Technology Stack. Traders spend $5,000 on courses but won't spend $15 on proper charting. That's like buying a Ferrari but refusing to pay for gas. The Minimalist Arsenal. You need 3 things. Everything else is procrastination. 2018. My setup looked like NASA mission control. 6 monitors, 15 programs, 10K invested. Results, information overload, confused, lost money. 2025, my setup fits in a backpack, 1 laptop, 3 programs, $50 per month. Results, clarity, focused, 7 figures. What changed? I learned the truth. Tools don't make the trader, decisions do. The only stack you need. TradingView Pro at $15 per month. Charts, analysis, back testing, better than 3 KT platforms. Broker with API varies. Execution only, not for analysis. Journal using Google Sheets free. Track everything. Your real education. Total. Less than Netflix plus Spotify. But here's the tool nobody talks about. Your trading journal. Not just P&L. Deep analysis. Entry reason specific. Emotion before, during, after. Rules followed, broken market conditions. Lessons learned. My journal template. Date, pair, direction, entry, stop, target, result, grade, lesson. The grade column changed everything. Forces honest evaluation. A please equals perfect execution. B equals minor mistakes. C equals major mistakes. F equals broke rules. Track for 100 trades. Patterns emerge. Weaknesses exposed. Edge refined. That's it. Anything else is mental masturbation disguised as preparation. How much have you spent on trading tools? How much have you made from them? Are you buying tools to trade better or to avoid actually trading? Sometimes the best setup is the simplest one. Sometimes less really is more. Tools are worthless without community. And I learned this the hard way. Chapter 19. The community code. Trading alone nearly killed me, literally. Here's what saved my life. The isolation trap. Markets are psychological warfare. Don't fight alone. November 2019, 3 a.m., 7th straight losing week. Account, down 68% from peak. Relationships, destroyed. Health, what health? Hope, gone. I wrote in my journal, maybe everyone's right. Maybe I should quit. Maybe I should just... Then my phone buzzed. Message from a trading buddy. Rough week. You good? 2 words. Saved my life. We talked till sunrise. Shared losses. Shared pain. Shared hope. He'd been there, survived it. Showed me how. That conversation changed everything. But here's what really happens in good trading communities. It's not about signals. It's about survival. Real traders share massive losses and how they recovered. Broken rules and the consequences. Emotional breakdowns and coping strategies. Actual statements, good and bad. No ego, no facades, just truth. My trading group has 3 rules. 1. Share your worst trade weekly. 2. No hindsight analysis allowed. 3. Help someone newer than you. The magic happens in vulnerability. When a 6-figure trader admits they tilted and lost 20K, suddenly your $500 loss feels manageable. Trading isn't a solo sport. It's a team sport disguised as an individual one. You need accountability partners to keep you honest, loss support to keep you sane, strategy discussions to keep you sharp, success celebrations to keep you motivated, reality checks to keep you grounded. My first profitable year came after joining a serious trading group. Coincidence? No. But here's how to find the right community. Avoid groups that promise signals, only show wins, charge monthly fees, feel like cults. Find groups that share losses openly, focus on process, have experienced traders, feel like family. The best trading communities feel like AA meetings. Everyone's fighting demons. Everyone's supporting each other. Who knows about your trading? Really knows? Losses and all? If the answer is nobody, you're one bad week from disaster. Ego says trade alone. Wisdom says find your tribe. Which voice are you listening to? You've got the knowledge. You've got the tools. You've got the community. Now comes the moment of truth. Chapter 20. The 2025 Action Plan. In the next 3 minutes, you'll make a decision that determines whether you're still broke in 2026 or building wealth. No pressure. The timeline split. Every legend started with one decision, to begin. 2 universes, both possible, both starting, now. Universe A, the Watcher. 1 year from today. Same job, same income, same dreams. Scrolling Instagram, watching others win. I should have started when I watched that video. Universe B, the Trader, 1 year from today. 6 a.m., coffee in hand, checking positions, up $2,147 overnight. Those first 6 months of losses, worth every penny. Both futures are real. Both are possible. The only difference, what happens in the next 180 seconds. But wait, before you act, understand this. The real heist isn't stealing money from markets. It's stealing back your time. Every profitable trader reaches the same realization. Money was never the goal. Freedom was. Freedom to wake without alarms. Freedom to travel without permission. Freedom to say no without consequence. Freedom to help without limitation. The account balance is just a number. The life that number enables, that's everything. I know traders with $10 million who are miserable, glued to screens, addicted to the game. I know traders with $1 million who are free. They trade 2 hours a day, spend the rest living. As you begin this journey, decide now. What does success look like? Is it a number or is it a life? Trade for the life, not the number. The number will follow. This isn't just about trading. It's about becoming who you were meant to be, using trading as the vehicle. The heist isn't about taking. It's about taking back your time, your freedom, your life. Now, are you ready to begin? Success isn't about IQ or capital or luck. Success is about one thing, starting. Chris Sacca started with 4 CEO borrowed on credit cards, now worth $1.2 billion. The hardest trade I ever made wasn't my biggest winner. It was opening my first paper trading account. Everything else was just repetition. 10 years from now, What story do you want to tell? I watched the video, it was good, then I did nothing. Or, I watched the video, opened a paper account that night, lost for 6 months straight, kept going. Now I trade for a living. Your story, your choice, right now. The final protocol, 3 actions. 30 seconds each, screenshot this roadmap. Week 1 to 4, paper trade religiously. Document every trade. Month 2 to 3, test with micro capital, feel real emotions. Month 4 to 6, apply to prop firms, use their capital. Month 7 to 12, scale and compound. Build your fortune. Open paper trading account. Link in description. $0 required. No excuses left. To prove to yourself that this isn't just another video you'll forget, go to the comments right now and write Day 1. This isn't for me, it's for you. It's your public declaration that today, you stop being a watcher and start being a builder. I'll be reading every single one, and your journey of accountability starts the moment you hit post. I'll personally track your progress. Free resources in response. Accountability starts now. 90 days later, send me your results. Real talk. 80% won't do anything. 19% will start and quit. 1% will transform their lives. The 1% isn't special. They just have one trait. They take the first step while others debate. Remember, every professional trader started exactly where you are. Scared, confused, broke. The only difference? They started anyway. Right now, someone just opened their paper trading account. Right now, someone just committed to changing their life. Right now, someone just joined the 1%. Was it you, or are you still watching? Welcome to the 1%. The heist begins now. See you on the other side, where freedom lives.